Let's go to our material 420. Excellent. Let's talk about the volatility, and specifically, let's think about the points of entry and exit. You know how volatility identifies those for you, for us. We kind of seen on SunPower a really great example of the volatility. Volatility, a measurement of change in price over a given period. So I want to make sure that everybody understands the way how I am applying, this volatility uh, definition. A measurement of change in price. So it doesn't necessarily mean a measurement of change in price that goes down. Usually volatility would be associated with increase of price action to the downside. And rightfully so. Whenever the price goes down, we have more intensity because people capitulate based on fear and panic, and that produces a much quicker moves to the downside. But we also could have the same type of exuberance or aggressiveness to the upside as well. There are some spots where there is an urgency by institutions to be in the position, so they are more aggressive in their buying. And volatility is going to be, a measurement of that change in price. It is usually expressed as a percentage and computed as an annualized standard deviation of the percentage change in daily prices. Okay, well, this is something that I was drawing with the previous cycle, and I'm just using this as a slide. So please forgive me, for all of this drawings, but it's just basically a discussion on the stop losses. And we usually start our discussion with the price stop losses. We usually would say that we want our stop loss to be, let's say, a significant bar away, or maybe two significant bars away. And one of the stop losses is going to act as a price, and the second stop loss is going to act as a time stop loss. So what's the difference there? With the price stop loss, we're basically waiting for the price to hit that stop loss, that price, and then we are out. Right? So for instance, as the price was moving up, we're using the staircase here, and then it gets us out here at the first sign when the price touches that stop loss, and that order becomes a market order and being triggered. The time stop loss is going to be associated with some kind of timing tool, timing reference. So for instance, we could say that if the price goes below this level and at the close it is below that level at the close of that bar, then we are exiting. And that would be our time stop loss based on the time period identification. We're also going to have a volatility stop losses. And the first time I heard about volatility stop losses was from Ed Sequoia. So Ed Sequoia was at the time when I first had an opportunity to meet him at Golden Gate class, and Hank was, brought him up for us. A very unique trader, a very unique personality as well, I would say. I think I know him a little bit better, that I've talked to a lot of people about him and heard a lot of stories. So not going to go into the personality, but let's just think about the him being a trader. So he was one of the first coders in late 1970s, early 1980s, who was coding different money management systems. The market was different at that time, so the coding obviously was, was different market ideas. He was very successful. One of the things that he talked about in that class was how to get out, and volatility stop losses was one of his kind of like favorite subjects to discuss. What is that volatility stop loss? It's when volatility starts to increase either to the upside or to the downside. And it brings us to the overbought condition in the longer trend in the trade that we participated. And once you go into that overthrow, overbought condition, your volatility stop loss will kick in. And you would want to tighten that stop loss, and still it's going to be based on some kind of price reversal. But you could also use, let's say, volatility from the perspective of how much volume comes in as a confirmation, and maybe as a confirmation of the reversal itself. Well, let's look at the volatility in the price cycle. Actually, let's first identify how we look at the volatility, right? So we could look at the price and we could define the areas where volatility increases, right? So for instance, on the upside, increase of the volatility. On the downside, increase of the volatility. Something like this, right? Where we're going to be identifying some extremes where maybe the price overcomes regular environment and regular structural spots where it might go into some oversold or overbought condition. How would we catch that? We could catch this visually. There is no reason for us to use any of the technical analysis tools, but if you want to use technical analysis tools, Bollinger Bands, which is based on the moving average and deviation around that using the standard deviation, we could see how volatility increases and decreases. So we would have pockets where the price moves, volatility increases. We could see how the band is increasing. The price goes into the consolidation, volatility decreases. And therefore, there's technical analysis dogmatic statement that after the contraction, expansion will come. We could think about contraction, expansion from different perspective, from the perspective of the rotation, right? We could say that during the contraction, there is a short-term weakness, and therefore short-term value that is being created. And with this short-term value, then institutions want to go to that and be buyers. Once expansion happens, that leads to the deviation from the mean, and that leads to some kind of extreme, short-term extreme. The short-term extreme produces the mean reversion trade, produces profit take-in, and that in fact produces some kind of reaction that leads into the trading range, that leads into the contraction, that leads into the expansion. Cycle repeats itself over and over and over again. All right, so why are these Keltman channels and Bollinger Bands as tools so important to us? Well, they identify those extremes in different environment, whether this is environment of the non-trending environment or environment as a trend. Let's look at some examples. 3D system, daily chart, Bollinger Bands. We're thinking about the Wyckoff context here, the trading range. And as we look at the Bollinger Bands, look what happens. On the way down, and this was a potential phase C, we have multiple oversold conditions, but as we go to the long-term support, this is the oversold condition that we are mostly concerned about. This is of interest to us. We want to see some kind of kickoff in the momentum. I'm using the rate of change here. That could bring the price in such way that would show a different behavior. So for instance, overcoming the moving average in a significant way and then staying above it. Instead, touching it, going down, touching it, going down, touching it, going down, touching it, going down, touching it, going down. So something different, a change of behavior. And when we change that behavior, we want to make sure that we understand how the price behaves around the moving average, how the price behaves in terms of the volatility, how the price behaves with the momentum. And we want to note where those touches happen. So for instance, tactically, it's going to be extremely important for us to say that we could have a touch of the long-term moving average, and then this moving average will be touched several times. And we could have different type of trades from here. We could have swing trades, that we know could last for the time frame that we need. And then once the price is going to be in a more short-term weakness position, then we're going to consider this more as the long-term opportunity for us to go in and to establish the position. And again, in December, I'm going to go through the whole price cycle. I will identify for you all of the position spots, and we'll talk about different tactics and different interpretations. So it will all come together, and that would be kind of like the final product that Wyckoff Analytics is going to have. What else here? Question: what is OBV and how does it differ from the volume we normally look at? On balance volume, so we want to look at the cumulative volume signature, where we are calculating the up and down volume on the up days and down days, and that cumulative volume shows us, let's say, an increase in the buying activity, where buy days volume exceeds the down days volume. And that usually shows you, especially in the original accumulation, the way how accumulation happens. It's a little bit more problematic, with reaccumulations, as you could see, if this is a reaccumulation, OBV line is going to kind of like regress, stay in the trading range, and hopefully just show you that it's going to go up. But in the original accumulation, there is a period of time where the trend emerges. OBV actually could play a really interesting role. Well, the same stock, and we're looking at almost the whole price cycle, at least from the beginning. This is our phase C in the big accumulation. And we said that we want to note the places where the price is going to have a very short-term oversold condition that is going to be significant, something like this. And these are going to be our long-term investment add-ons. Yeah, so long-term investor is going to be interested in this type of opportunities. Where else do they come? Well, here it is. Here it is again. Here it is again. Here it is again. And throughout all of this opportunities, whether you're coming into the position as a long-term investor or you've been staying in this position for quite some time, please note 2009 to 2014, 5 years. So that's a pretty sustainable uptrend. These are extremely interesting spots to us. And again, in December, we will talk about what kind of trades are the best trades. And if you're thinking about maybe even long-term trades, I will tell you right away that those are not necessarily going to be the best, most optimal, most efficient trades if we were to extract the maximum amount of money using all of the instruments that are available to us. And I will tell you the reason why. But at this level, we want just to notice where we would be aggressive buyers in this price cycle as long-term investors. So short-term weakness close to the technical oversold condition. There's going to be some other places where we will originate swing positions. Those are going to be minor reactions. These are the minor reactions. So this is a major reaction. Major reaction, and I would say even probably this is a major reaction. This major reaction, this definitely is a major reaction, and this major This. So 1, 2, 3, 4, 5. We'll talk about 3. This kind of like is a special case for us. Everything else, and I probably would take this one as well. Yeah, so 3. Let's just label it like this. 3, 4, 5. So we have 5 major reactions in this cycle. Those are great spots for the long-term investor. We also have quite a few minor reactions, right? So these are the reactions that are going to be maybe into the middle of the channel. These are the reactions that are going to come in the trend between 2 major reactions, and they will always have some kind of swing opportunities for us that are more short-term oriented swing opportunities. And it's going to be easy for us to trade those reactions once we understand, how they occur, where they occur position-wise, and how we trade them. This is where the Wyckoff layer would come. This is where the volume and spread analysis would come, time in, phase in, and so on and so forth. So you kind of already see where I'm going with this. So there's going to be quite a few minor reactions. Minor swing opportunities. Okay. Those are all tactics. This is the way how we would be trading this whole price cycle. Okay, so then we definitely also going to have some of the momentum trades. We usually would identify those in 2 spots, and I'll show you today which ones we would be thinking about. I'm gonna try different color here. This is also okay. So momentum off the bottom into the climax, off the bottom into the climax, off the bottom into the climax. Those are the 2 momentum spots for us. We'll talk in a second why it happens this way, why off the bottom and in the climax, and what's in between. And then we're also going to have the trades that are going to be mean reversion trades. Mean reversion trades could be different for us, right? So we could be very short-term oriented for the mean reversion trade, or we could be long-term oriented, or rather longer-term oriented, where this mean reversion trade is going to happen into the strength with the short-term elements indicating that there is a temporary distribution on the profit is taking place. And you could either have a trade at those spots if you're very aggressive. I've been conducting quite a few of this lately. I've shown you 2 of those trades, and one in gold where I'm campaigning gold, and yet I'm hedging at those spots. And then TLT the bonds, kind of the same trade, the same idea. So we will specifically identify the spots in the price cycle where this overbought condition happens, and that would trigger a specific strategy to take place. So at the end of this strategy, which I'm calling right now this system, I don't have the name, so if you have the name, that would be great. Come up with the name. We're going to have multiple strategies that is running at the same time. Long-term strategy that is going to have different tactics. Swing strategy that is going to have different tactics as well. And those are going to have different tactics as to what we trade at which structural spot and how we trade it. So by December, all of this is going to be kind of fully rebuilt. And then we'll talk about this spot. So not today, but this is something different. This is not a minor or major reaction. This is a full-blown mid-cycle reaccumulation. So we'll talk about this as well. Let's jump to the next slide, a number of slides. Characteristics of trends. This is the material that I presented in the bow for those of you who have not attended. This is just an abbreviated version of this. Characteristics of the trends. And it will become more apparent of why we're using this when, you know, everything will be put together. Here I just want you to notice the way how the price cycle, the long-term price cycle, develops. We're still in the uptrend, if you can believe it, for Apple. And we're still in this huge price cycle of expansion. We see where institutions got into this position. There is no denying that there are different stages of how they were coming into this position. So early accumulation, very aggressive accumulation on the way up, and then late accumulation. What are they doing now? CO is inactive. What does it mean, by the way, CO is inactive? Does it mean that the CO does not have a position? Eric is saying he is neither buying nor selling. That's correct. But my question is, do they have any shares at this point? What do you guys think? Dmitry is saying, okay, not buying or selling. Okay, and both of them are saying, yes, they could. Yes, if they haven't distributed. Well, do you see elements of the distribution yet, Eric, here in the volume signature or in the price action? No, no distribution yet. So therefore, what's the conclusion here? The conclusion is such that this whole area right here was a prolonged institutional accumulation of Apple. And now they're holding this position and they're not getting out. That's what it means to be inactive. Inactive meaning not being in the market. That, okay, I understand. That could happen as well, usually in the stock that is going to be abandoned completely by strong hands, and the price will be just kind of like floating and fluctuating on smaller speculation campaigns, or maybe just weak hands are kind of moving it in a drift. We see a lot of those stocks, especially in the liquid markets. Usually liquid stocks are going to have some presence, some institutional presence, but in the liquid stocks, there is an abandonment sometimes by the CO and they don't participate. So that's a different activity. In this case, they've been extremely active for the number of years. They've got into this position. By the way, if we are thinking about, you know, this long-term cycle, they got in here, and then on the momentum, they got in all the way up. So this whole move from 2003 to 2007 is just accumulation on the way up. And then they started adding to the position, you know, on the next move up. And then in the last 2 or 3 legs up, they are not really participating that much. And that's where momentum has been lost for Apple. And if Apple goes down, it should come to the area where, lastly, there was some elements of accumulation, not in the trading range, but on the way up. And this is this, you know, move right here. And it's slightly below $100. So like on the level of 2015 trading range right here, 2016. Would be interesting to see that, but we have to see some kind of elements of the distribution. We need to see a break to the downside. We need to see an increase in the supply signature for us to talk about the distribution yet. Okay, well, let's look at the characteristics. How does price move? Like all of these moves, all of these legs up, do they have similar characteristics? And I was going through different stocks, and doing this visual backtesting. Uh, Definitely, there are certain ideas, certain textures, certain actions that come out, and you see them right away. So what are they? There are periods of absorption where the price kind of, let's say, has a movement in the direction of the uptrend, and yet, let's say, the volume signature goes down. You could also see the absorption, like, it could be a horizontal absorption. You could also see the absorption with somewhat of the laborious vertical absorption type of action where the volume signature increases, there are multiple reactions, and every time the price reacts, then it goes up again, and then it goes down again. So this laborious move to the upside where there is not a lot of momentum just suggests that there is a lot of absorption that is happening as the price travels up. Then we also will have elements of the momentum in that trend. This is where institutions are going to be getting into this position aggressively. And with that, the price will move aggressively up as well. So institutions are coming into this position, are buyers, and they are aggressive buyers, aggro buyers. This usually will move the price really quick. And then the last phase is going to have some kind of speculative qualities. Why would we have speculative qualities in the last phase? Well, because supply has been absorbed, then supply has been absorbed as well in the momentum phase, and even more so, and the price has moved to the next level where supply is not available. And then in the last move to the upside, imagine that supply has been absorbed. What kind of move are we going to have without the presence of the supply, or without a significant presence of the supply? Most likely, this is going to be a very fast move. This is where swing strategies are going to be more appropriate. And we could define the areas in the trend by the strategies that we could use. And that's, again, something that I will incorporate into the December material. Let's look now at examples of the downtrends. Same stock, same price cycle. Let's look at the downtrends. And they seem also follow the same stages as an accumulation, or they have the same kind of like elements that are attributed obviously to the distribution here. Contrarian effort. This is the value investors that are selling into the strength. So usually they're going to come in the last move to the upside, into the climactic action, and the changes of character are going to be the first signs where they're distributing up thrusts. Also going to be, the points where they will be selling into the strength of the movement to the upside. Those contrarian efforts are going to stop the price from moving further up, or going to be attempts to stop the price from moving further up. After the value investor is out of the position, we're going to have some early institutional capitulation. Those are going to be the money managers that are going to be very, very smart money managers. They're going to recognize a couple of things. They're going to recognize that big fish is coming out of the position, and they're going to also recognize deterioration either of the current trend or a break of the trend. So in first case, we could see a deterioration as a lower high. We could see deterioration on the change of character. And then as the price falls, early institutional capitulation happens. This is the smart money getting out. Late institutional capitulation is going to be associated with the continuation of the deterioration. And usually late institutional capitulation is going to be such where the break of the current environment or a trend is going to be very obvious. And why are we talking about all of these things? Well, because if you recognize the characteristics for the late institutional capitulation, this is where you want your swing trades to happen. Obviously, in this case, to the downside. So you would initiate the trade here. You would also initiate the swing trades during the general capitulation phase. General capitulation phase is something that happens after smart money is out and there is weaker money that is left, whether institutional or retail. And it's going to be associated with a general panic. This is where everybody is giving up on this position. And we see that in the second example in 2000, right? So obviously associated with the market move, but still, look at this general capitulation. Usually going to be aggressive, either in distance or in character, as well as the late institutional capitulation also would be usually more aggressive than the change of character from the value sell and also from the early institutional capitulation. Okay, I hope it all makes sense. A couple of questions. Dmitry is asking, for swing trading, while keeping the bigger picture in mind, would we use intraday data, 4 hours or hourly chart, for smaller Wyckoff structures to identify points of entry and exit to swing trade the campaigns? Dmitry, that's usually how I do this, but I'm always kind of like in front of the screen, so I can do that. If you can, I think that daily charts is totally fine as well. From Simon, does this mean that with general capitulation that we wouldn't necessarily see the down move with increased volume? What is this HV, high volume, increased volume? We usually will see, and we think about the general capitulation as the majority of the hands that are left are going to capitulate. So therefore, your volume signature should increase in general. And then you might have some variations. So for instance, in this capitulation, even though it's still aggressive, I mean, like, look at this area right here. This is a pretty big decline in a very short period of time. 155 to $50, 50 cents. Wow, that's a huge decline, and it happens in 1 year. Obviously, late capitulation here was much more attractive for a swing trader, but you would be thinking of a swing trade that's going to have multiple legs to it. You're probably going to have 1, 2, 3 legs, which makes a lot of sense as well. All right. So we could see we usually on general capitulation would see that high volume signature, Simon, and that would identify a number of market participants getting out of that position. So I want you just to remember this sequence. Maybe this is the sequence of smart money, or rather the smart money barometer of where different market participants are exiting. Our smartest of them all are going to be the value investors, and they're going to sell into the strength. Our next smartest group is going to be early institutional investors that are going to capitulate early. They are not going to produce a significant change of character, but it will show on our map that they are selling. And then when everything fails in the institutional world and no absolute or relative return is being given, late institutional capitulation happens. And then the weaker hands, the I don't want to call them dumber hands, but still not as smart money are gonna move last, and then they gonna capitulate last. Please note, and this is not a coincidence here as well, after initial institutional capitulation, what happens next before general capitulation? We kind of drift, right? Trying to go up. Why? Well, because the first three market participants are inactive here again. And what does happen here? Why do we have those volume spikes, multiple volume spikes? Well, because this is a mean reversion trade in place. This is all mean reversion, and they're usually going to come at those points of extreme, either at the top or at the bottom. CO is inactive. So CO is not the value investor. CO is not the early investor that's going to get out. CO is not the late institutional investor. All of them have made money, on those moves. CO is a composite of these three. And that's the confusion I think that, we kind of had, because usually CO would be associated with strong hands, and this is correct. But there are different type of institutions that would comprise the CO, and usually CO will be done before the general capitulation happens. And that's kind of like that difference. So strong hands, weak hands. And then within the strong hands, smartest, smart, slightly off. Off smart. Something like this. So I like how inactivity here happens before the general capitulation, and we see that from the volume signature as well. There's nothing that's going on. All right, great. Now let's practice this. Let's go to trends, and specifically what I wanted is I wanted to go through the price cycle and look at volatility, and I also wanted to look at the character of the next move. All right, volunteers, maybe this is something that I probably need some help with. And any stock that you want to discuss that maybe in the last 10 years had a significant rise and significant fall. So let's just identify some interesting candidate. Give me a symbol, maybe a volunteer. All right, Eric wants to step in, but we still need some kind of symbol. Hi, Eric. Are you there? Eric, are you there? I can't hear you, so maybe something with the microphone. Okay, well, guys, think about any of the stock that, let's say, had some kind of big runs. So how about some of the momentum stocks? Okay, miners. Well, what I meant is, where we had a significant move to the upside, was the conclusion. Okay. Not the most recent moves. Okay, well, here's the price cycle that we see here. Okay. All right. Yeah, we could use this.
Hello.
Yeah. Hi, Eric.
Hi, sorry.
No worries. All right.
I'm always having headphones issue. I have to go in and physically, or not physically change it, but
Uh-huh.
anyway.
No worries, no worries. Okay, so looking at the whole history of the stock. So uh, let's kind of, from the historical perspective, try to identify where we are in the price cycle. What do you think, Eric? Like at this point right here, where are we in the price cycle?
Well, I guess what's confusing me a little bit is, I don't see a top here for the last 10 years, kind of been, from a relative perspective, going sideways, really.
Okay,
We've been,
this is a good first step. Okay, so we need to identify, like I'm talking about position here, right? So I call this mapping. We need
mhm.
to find on our map of the price cycle, where are we in the price cycle? So we are going to have in the price cycle what? We're going to have an accumulation.
Mm-hmm.
We're going to have a distribution. We're going to have reaccumulation, redistribution. We're going to have also some minor corrections, right, on the way up, minor corrections on the way down. Where are we?
I'm going to say reaccumulation.
Yeah, well, there is no other answer so far, right? So we are either in the distribution or we are either in the reaccumulation. We have had a trading range that lasted for multiple years. We have had a markup that has lasted also for multiple years, and then we have had a trading range. So we are probably somewhere here. The reason why we're saying this, well, we're looking at what this is, gold mining, so extremely bullish bias for the whole group. And we're thinking that the price could potentially continue with its move to the upside, especially if, the world economy is going to hit some kind of, hard recession. We're definitely going to be favoring gold and gold mining stocks as a flight to safety. So therefore, we are thinking that this is probably a big reaccumulation in the larger price cycle. This view could change if the price is going to start behaving differently, but for now, this is what we're assuming. Okay, this is where we are now. Let's think about what has happened before. I want us to think about certain characteristics that I've discussed, trend characteristics, um, that would identify specific strategies and specific traits for us. So let's talk about those traits. We usually would be attracted into this area right here because this is the area of the markup. This is the area of the trend. And I'm gonna expand this portion, and then we're gonna go through different items on the list here. Actually, could we take another stock, guys? Actually, no. Let's just do exactly what we would be doing here. Okay, this and let's say 97. Okay, so here is the whole markup, and let me just increase maybe the height. Let's do 75. Okay, slightly better. Okay, so first, let's figure out the volatility points. Where do you think the volatility is going to be the highest for us on this chart?
I mean, based on what I see,
Mm-hmm.
or,
Yes,
well, we see volatility highest as we leave the trading range in middle of '05,
okay,
and we hit the kind of the buying climax with the volume signature there in April of '08.
agreed. Where else? And think about the volatility definition, right, guys? So volatility is a price change measured by the standard deviation. So we're deviating, above, below the mean. Okay, so here's where deviation has happened in the extreme way. So we definitely have a lot of volatility to the upside. Okay, where else? Would we be thinking then maybe this type of spots as well, where that happens? So I would probably be thinking maybe like somewhere here at the end of the climactic run, right?
Right. Yeah. So
Maybe
April of '08.
somewhere
Yeah.
here, maybe somewhere here. Please note that in 98, we have that volatility off the bottom, right? So we were in the extremely oversold condition, and then we go into the overbought condition. So every time this happens, Eric, what kind of extreme are we going to experience here with the rally? Being probably in the overbought condition,
Yeah.
right? So overbought and overbought because we were still in the downtrend. Those are overbought conditions. Overbought, 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 overbought. So even without placing any type of volatility bands or using a simple trend line, I probably should do it like something like this. And actually, yeah, all right, first do it like that. I got, okay, probably not. Okay, let's use another trend line. I'm
Do
gonna
you ever
use,
use the reverse trend line to identify the overbought?
yes, I'm using it right now.
Okay.
And
All right.
let's go
Okay.
through this. Absolutely. Let's go, let's kind of repeat. So we, and please don't forget, this is logarithmic.
All right.
Oh, all right. Let's just put it somewhere else. Okay. All right. So right away on those volatility spikes, we see the conditions that are overbought conditions. And that's in this whole markup phase. So what do we do with this? Well, as we've discussed, that increase in the volatility suggests that we have to be much more aggressive with the stop losses, and we should be also much more aggressive with our profit taking, with hedges as well. So we would be thinking mean reversion trade, profit taken plus hedge, profit taken plus hedge, profit taken plus hedge. What would that do to us, right? Or rather our equity line. So if we are thinking about this mean reversion trade or a hedge trade, how would we develop that? Well, obviously we would be thinking about what comes next after the buying climax. A change of character. And a change of character is going to be associated with automatic reaction and increase in the supply signature. So we could place a trade opposite to our long-term trade if we're long-term investors, or if we're swing traders just to get out and to have a quick swing trade to the downside, let's say. And those are high probability trades, if you can imagine. I mean, it's just happens this way that, and I was thinking maybe in life in general, it's just like there is a norm and then there is a deviation from the norm. And the more there is a deviation, the more extreme it is. And therefore, when you see the extreme, just, kind of go in the opposite direction, a contrarian view at that point of time. And usually that norm will come, to a mean. And that's what we're having here. And I think with the hedge trade, we don't really need a lot. We just want to catch that first momentum to the downside and to stabilize our equity curve from that point of view. So, and again, we'll talk about this in December a lot.
So from what I heard you say, that basically what you're trying to catch is the change of behavior into the automatic reaction.
Yes. Right. Okay. For different purposes, right? So
right.
We either in a long-term campaign and we're hedging, a long-term campaign and we're profit taking, or we're swing traders, we're exiting, and we are short-term swing traders, we just want to play that mean reversion trade.
Okay.
So we need to understand who we are. Absolutely. Okay, so this is on the upside. Now think about the downside once we have an established uptrend. This is also going to be extremely useful and attractive to us. How do we look at the long term? Well, we identify the places of price behavior where the price spends, let's say, time below the moving average, but still in the channel and close to the channel itself, like this one right here. And those are going to be our major buying opportunities in this cycle, right? So we are doing a mean reversion opposite to what we've done with the volatility to the upside. And please note that usually we would hope to have some kind of local volatility here on the increase. Some local volatility increase. Some local volatility increase. So we want to see that because it usually will tell us the timing of potential phase C. And in this case, volatility comes on the change of character. So usually volatility to the downside is going to be a change of character, change of character, change of character, change of character, and then potential phase C in the reaccumulations. So those are going to be other spots of interest to us. And then let's look at the texture with which the price moves up. Where is our momentum stage? Where is our speculative stage? And where is our kind of like absorption stage? Eric, would you like to give it a shot? I think that from this perspective, maybe it's a little bit harder, but let's just see what we can come up with.
So, so the three options were, absorption, speculation, and momentum, right?
Momentum.
So I would say starting in 98, October 98, well, even before that, I guess that's October 97. We have, it looks like some preliminary support on the way down. So there's some absorption of supply happening there. October 98, that's the selling climax. We seem to go into a trading range until 01. So there would be some absorption happening there. And then we have kind of the first evidence of an uptrend move at the beginning of '01. So that would be the beginning of our momentum stage, '01 to middle of '02.
How about this? How about we approach this? Let's just kind of like approach this from the perspective of the definitions, right? So speculation and momentum. I think those are the ones that are easier to identify. For instance, where is our speculation, do you think?
Well, speculation is at the last part of the up move, and it's usually kind of more parabolic in nature.
Right. So let me just give you a different perspective. We're kind of like looking into this area, but we're not seeing really what has happened here just because this is a log scale. Okay. Here's your parabolic move, right? So that has some kind of speculative nature. So I would say that maybe this whole thing has its own like speculation wave, and that also has like those three major things: momentum increase, then we have absorption, and then we have the final speculation. This is where the price more than doubles. And then before that, we could see, and it's kind of like maybe like a fractal within the fractal. On the log, we better see the beginning of the move. So usually when we talk about the momentum, we will be, let's say, looking at some momentum indicator, or even just on the price action itself. So here's a momentum. Here is a momentum here. There's going to be a lot of momentum out of the preliminary support just because there is just an attempt to buy, and it's going to be something different. Here is a momentum as well. So we kind of identified that. And on the rate of change, you're going to see that, right? So all those big spikes, those are the momentum spikes that we look for. So I think that the original momentum phase is going to be somewhere here. It's just a little bit obscure, but if you think about the pricing here, so from $2.50 to about, what is it, $8.50. So that's a big momentum move in a year. And then we are going into this prolonged period where we have some kind of absorption. And it also has different segments behind it. We see that the momentum has a lot of like this spikes up momentum. This is that reaccumulation as a rotational pattern. What happens here? Well, there is on the value, there is a lot of buying in phase A and early phase B. And what happens here is that some institutions that are strong hands, they are selling, as we've talked about, and then some strong hands are buying. Those strong hands that are selling are kind of seeing, maybe like a short-term deterioration, so they're taking profits. The strong hands buyers, they are seeing that the future valuation is probably somewhere higher, so they're willing to come in on the liquidity and absorb this supply. Please note what happens after this phase A, early phase B rotational reaccumulation. Almost apex formation, diminishing volume characteristics, and inactivity by the CL. That's it. There is nothing else. After that, there is accumulation on the way up that has kind of like the same stages, maybe even of what we have had somewhere here of the momentum. So momentum always would sustain the move of the lows, and that's what we need for the price cycle. Okay.
So can I just ask a question
Yeah,
here? Like I understand what you said from 99 to '01 was, momentum move.
yeah.
But, from what I see, like I see 99 to 2000 as a momentum move, and then we're down for a year. So is that a period of absorption? And then we have another momentum move from '01 to middle of '02, July '02, another, sideways action for about 5 or 6 years, and then another momentum move.
hmm Well, don't forget, I mean, the stock itself,
Hmm.
right? So has a specific way of how it moves, depending on the cycles in this particular industry and so on and so forth. Um, and yeah, usually we would have uh, that type of sustainability of the trend. The sustainability comes from buying by institutional hands. So we see a lot of buying here, we see a lot of buying off this low, we see a lot of buying into the climactic action. Then we identify the next series of buying, and again, we'll be talking about this in November. Um, then the next series of buying, right? So somewhere here, here, and then the next one, right? So here we go. Um, okay, here as well, here, and then the buying is just subsides, and then it comes back here somewhere. So you could see what this buying that is being identified by the momentum, and this one's too, of course, what it does to the trend. It originates the trend, then it sustains the trend. So they are buying and then they're going away, they're inactive, they're kind of holding this position. And then when the price deteriorates to the levels where they're willing to buy again, their previous value zone, they're going to buy. That's going to be shown on the momentum and the volume signature, and that's going to push the price higher again. At the overbought condition, they're going to originate the mean reversion trade, and that's going to depress the price for some time. Uh, this is a specific pattern here, this rotational reaccumulation that happens early in the trading range. And then once we go through the trading range, it's when the highest momentum or the biggest buying starts to occur. That's when sustainability of the trend is going to occur again.
Hmm.
And then in the areas of the reaccumulation, again, if we're seeing some buying, there's going to be some kind of continuation. We see that here. And again, buying off the value. So you could see how big institutions are not necessarily have to be present on each day in the market. They usually don't. They establish the position, it takes weeks and sometimes months, and then they go away. And because they don't do anything, that locks up the supply, and that's how the price goes up. It is because there is no selling, the price is going up. And there is some additional buying. And then coming back into the short-term value, buy again, pushes the price up, creates the trend. So that's what creates the trends themselves. Those momentum buys by institutions, um, and that's what sustains the trends as well. All right, Eric, what else?
I'm kind of like, as you're speaking there, I just have this,
Aha moment,
I
epiphany.
don't know, I call it, it's almost like putting you're in your car, and there's a big push on the gas, and that gives you like a little boost of acceleration, and then your
Yes.
speed starts to fall off.
Uh-huh.
Another push on the gas, speed starts to fall off.
Yes. Good.
Push on the gas, yeah.
Yeah. Good analogy. Yeah. So it's
Mm.
like additional acceleration that you give for the car.
Little
Uh,
impulse, yeah.
yeah, a little impulse, and then it carries you through for some time. And
Mm.
then because that second portion, right? So initial impulse, and then the second one is going to have the deterioration of the momentum, right? So this is initial deterioration. Deterioration will bring some of the selling at some point. But all of this is not that kind of difficult, to put together, because when you understand how the price moves and all of the points, the position points in the price cycle, then you could kind of figure out where the failure could potentially have and where the confirmation of the resumption of the trend could happen. And then it becomes all a question of selection. Do I want to be in this stock or this stock that are structurally in the same position and that exhibits maybe different characteristics? So we'll talk about this as well. All right, Eric, I think that's it for today. This was kind of like on the fly exercise. I was kind of thinking about what we're going to do, and I think that we've done everything. I can't think of anything else. Do you have any other questions, or maybe anyone else?
No, I'm good, thank you.
Okay, great, Eric, thank you so much. Okay, couple of questions we do have. When you're referring to volatility, are you only referring to price, not considering volume, or do you, or does volume complement your assessment? Both. I look at both. Usually the emergence or increase in the volume would produce what to the result? Probably expansion. So therefore volatility would increase. So volume is closely associated with how the price reacts to the increase in the volume and the volatility in general. And the last question. That's interesting. Okay, from Dmitry. Roman, before you go, just wondering what are your thoughts on the competition coming into the brokerage business? Many brokerages drop in commissions. Yeah, and today we had that type of day where I just put this. Okay, so who dropped the ball today? Schwab, right? So Schwab said that we're going to have no commissions. Charles Schwab, am I correct? And this chart, stock charts do not even show this. Okay, let me show you on other charts here. Here we are. So in some instances we had like 20% drops, I think, in some brokerages. Let's look at some others. A-Trade, hold on a second, what's the symbol there? What's the symbol for A-Trade? I'm spacing out. Do you guys remember? Okay. Okay, I think this one, yeah. ETFC. Come on. Okay, so here is that dropped in E-Trade, Ameritrade, even more so. And please note all of the downtrends. So it's not like it has happened so unexpectedly. Whoever is in the industry, they know the trends of the industry, and obviously the smart money were, capitulating earlier. So let's just say that we close out this picture, and what would be the bias on this chart? Well, we're seeing some increase in volume signature on the way up, right? So what does that do? That's increase in the volume signature. It stops the price from moving further up. We see a lot of volatility and the climactic run. We're probably assuming this is value selling into the strength. So then we would be thinking, okay, where is our, early investors that are going to capitulate? Slightly not slightly, but smart money, but that usually sell after there is some kind of deterioration of the trend. And I think that this area right here depicts that capitulation by early institutional hands. They are seeing the deterioration in the price, they're getting out, they are maybe looking at some fundamental reasons, they're getting out as well. Then the late institutional capitulation is probably going to come somewhere here. And then a general capitulation is something that came today. This is where everyone is giving up, regardless. There is no reason to hold on to this position. The structure of the business changes, and that's going to produce a different structure until investors understand how you can make money without charging for a commission, and your profitability levels are going to be at the same levels as before, then they most likely are going to be disregarding the stock and the group in general. What are my thoughts about the competition? I definitely welcome it, because as you guys, could see maybe from your brokerage statements, I mean, even with current pricing, which is very low compared to, let's say, 20 years ago, when I started trading and investing, at that time, that was ridiculous. Right now, with all of the free options like Robinhood that we have, I think this is the trend. This is the direction that is being given to us. I'm curious as to what business model they will have. So how do they make money? Do they advertise and that's the main revenue? Do they sell something to the investors that generates the revenue as well? Or maybe they have their commission built in the spread itself. And I have to read on this a little bit, educate myself, on the business concept. But yeah, I'm definitely for it. Okay, last question, and we're gonna stop here. Could the high volume be considered buying by contrarians? Well, definitely somebody is buying on the value, right? But the main move today is to the downside. If you would be thinking, are there more sellers here or buyers? There are definitely more sellers, but there is a lot of buying that is happening here as well. The buying by itself does not mean that the selling is done, right? So, for instance, don't confuse a high volume signature with intelligent buying or a timely buying. We could say that, all right, well, here there was a lot of buying as well. What did it lead to? Just a quick rebound. So you have to put this into the context of where that high volume signature occurs. You might say that there is maybe more of the mean reversion trade that is possible here, and that produces some buys on this bar, rather than necessarily, long-term value plays. Although that might be the case at some point, and we should just wait and see. All right. Yeah, that's what I thought, Eric. So I think that brokers right now, yeah, making the money, behind the commission. I think this is where it's all going. So kind of like the commission's going to be built in the spread itself. Okay, guys, I think that's it for today. Good session, quite a lot of material, so kind of wanted to put it out there so that then next we would just, go through the exercises and all that stuff. All right, guys, until next week, don't forget about your bias game. Send me your charts, send me your questions, and I'll talk to you next week on the 8th. Thank you, guys, and bye-bye.